Hey, good afternoon, everyone, and welcome to the 2020 third quarter financial reporting update. I hope everyone and their loved ones are healthy and safe. I'm Jesus Socorro, and I'm the managing principal of MBAF's Risk and Transaction Advisory practice. Our practice is a global reach and focuses on services around IPO preparation and execution, internal control over financial reporting, technical accounting and financial reporting, IT risk services, and due diligence. I will moderate today's presentation. Joining me are Miguel Velasquez, principal in charge of our audit practice's quality control function, Emma Florea, principal in charge of our firm's New York Risk and Transaction Advisory practice, Patrice Harris, director in our audit practice focused on audit quality control, and Dennis Bartoe, supervisor in our Risk and Transaction Advisory practice with a focus on technical accounting and financial reporting. This webcast offers 1 hour of continuing professional education. You will have the opportunity to ask questions throughout the presentation, and we will make our best effort to answer them before the end of the presentation or circle back with you afterward. There will be 3 polling questions throughout the presentation, and you must answer each of the 3 polling questions to receive 1 hour of CPE. Within a couple of days, you will receive an email with the presentation and a link to the archived webcast, as well as evidence of your CPE completion. So let's get started. On our agenda, we're going to talk about some of the hot topics for the third quarter close. We're going to talk through SEC trends and updates, as well as FASB updates. So we're going to begin with types of government assistance under the CARES Act. Miguel?
Yeah, so thanks, Jesus. So the Coronavirus Aid, Relief, and Economic Securities Act, or better known as the CARES Act, has had a significant impact on various companies across multiple industries. And today we'll cover some of its provisions, accounting impacts of this act. Now, one of the better known aspects of the CARES Act relates to the Paycheck Protection Program, or the P. Now, this program expands on small business, general business loan program, and these loans really are designed to help small businesses during the COVID-19 crisis. Now, companies requesting a PPP loan must meet certain eligibility requirements and make a good faith that current economic conditions make the loan necessary to support operations. Now, the loans can qualify for full or partial forgiveness, and really the forgiveness depends on how these proceeds are used. Now, the proceeds need to be used to make payroll-related, or other eligible payments. However, no more than 40% of those proceeds can be used on other eligible qualified payments. Now, it's key to remember that the SBA has 6 years to audit the eligibility and expenditures used by the proceeds. So it's very, very important that companies maintain a good process to evaluate and monitor eligibility. So what are some of the accounting considerations associated with the PPP loans? Now, given the nature of the loans and what the loans were intended to do, there's been many questions regarding how to account for these loans. Now, the loan in its legal form is debt and can be accounted for as debt will be met, then the loans may be treated as government assistance, and we'll talk about the accounting model later in our presentation. Now, some other provisions of the CARES Act include the Employee Retention Credit, or the ERC, the Provider Relief Fund, and the Deferral of Payroll Taxes. With respect to the ERC, eligible companies may receive the ERC for each calendar quarter equal to 50% of qualified wages, not to exceed $10,000 per employee per quarter. And really, the purpose of this provision was to encourage employers to keep employees on the payroll even if they were not working during the COVID-19 crisis. Now, it is important to note that a company that does obtain a PPP loan will not be eligible for the ERC. Now, really, given the nature of this provision and how it's calculated, it was really designed as a vehicle to provide cash to companies quickly. In most cases, the credit would exceed the payroll tax, and in this situation, companies can request a direct refund from the IRS to account for this credit consistent with other government assistance. Another well-known provision of the CARES Act is the Payroll Tax Deferral Program. Many companies may defer their portion of the payroll tax from March 27, 2020 through December 31st, 2020. And just recently, there was an executive order issued in August that allowed companies to defer the withholding and payment of the employee portion of the Social Security tax for the period from September 1st, 2020 to December 31st, 2020. Now, it's very important to note that to date, very little guidance has been issued on how to implement the employee piece of this provision. But if you really step back and think of the accounting for this piece, companies will still need to accrue for the employee portion of the liability, but they'll be able to set up a receivable from the employee for the same amount. Now, the key takeaway here is that a company that does elect to implement the employee piece of this provision will need to evaluate the collectibility receivable at year end, which will be very, very challenging given the uncertainty surrounding this piece of this provision. Now, another thing to keep in mind that even though the payroll tax will be deferred, companies will still need to accrue for the tax liability and the expense in the period incurred. And then the amounts will be due in 2 equal installments beginning December 31st, 2021 and December 31st, 2020. And finally, the Provider Relief Fund was really established to provide direct assistance as hospitals, clinics, and other healthcare providers to treat COVID-19.
Thank you, Miguel. What about as far as accounting models for government assistance go? Can you talk through that and the bodies of GAAP that you look to?
Sure, Jesus. So now we'll discuss how business entities can account for this assistance or grants from the government. But really the first question companies need to consider in these situations is whether consideration represents a payment of goods or services ordinarily provided by the company. So why don't we take some examples to highlight this point? If you're a hospital and the hospital is paid by Medicare or CMS for the services that are provided to a patient, then provisions in topic 606 would be used and the assistance would be considered revenue. In this example, the government is paying on behalf of the customer or patient and therefore in scope of 606. Another example is when a company receives an incentive from the government to help manufacture a specific product, like a ventilator or face mask, but really the purpose is that the government will ultimately be the purchaser of these products. And in these cases, the assistance might be considered a 606 arrangement. And in this example, the government is considered a customer and therefore under topic 606. Now, there might be other government assistance that might come in the form of an income tax credit, which typically include research and development credits, investment tax credits, and these are typically under the scope of topic 740. Now, the key takeaway here is just because something has the word tax in it, it doesn't necessarily mean you're in the scope of 740. Only if those credits are based on a company having taxable income do you end up in topic 740. If you have the ability to monetize a credit even though you don't have taxable income, these are sometimes referred to as refundable credits, and companies can get them in cash even though they don't have taxable income. Now, these are outside the scope of 740. So we spoke about the ERC in our previous slide, and even though this provision does have the word tax in it, it does fall outside the scope of 740. The CARES Act also offers below market interest rate loans, but the fact that these loans are below market does not make them government grants. There is specific guidance in topic 835 that indicates that companies should not impute interest when rates are determined by the government. Now, if you recall in our previous slide, we did discuss how a portion of the PPP loan might be forgiven. And in this situation, the forgiven piece might be treated as a government grant and not in the scope of topic 835. Now, in most cases, when you think of the PPP loans and other provisions of the CARES Act, the government will not be considered a customer or really paying on behalf of a customer. Now, there is no specific gap that addresses the accounting by business entities for this type of government assistance. And really determining the proper accounting can be challenging and will likely depend on an analysis on the actual nature of the assistance. But first, companies should look for guidance for a similar transaction or event within US GAAP to apply by analogy. If no guidance is identified, a company may consider non-authoritative guidance from other sources. Subtopic 958-605 contains specific guidance on government grants for not-profit entities. However, it does exclude government grants to business entities. Now, However, if you're in the scope or elect to analogize subtopic 958-605, revenue will be recognized when the conditions are substantially met. The presentation is a gross presentation, either through grant revenue or other income. Now, the key takeaway under subtopic 958-605 is the concept of offsetting does not exist in this guidance as it does under IAS 20. So it's very important that companies have a sound process in place to evaluate and monitor the compliance of these conditions. Now, if a company does analogize IAS 20, there are a few things to consider. First, you must be reasonably assured that the company will comply with the conditions necessary to receive the grant. And secondly, and probably the most important point, is that you must have received the grant. Now, the key takeaway is that IAS does not define reasonable assurance, but it is considered similar to probable as we use it under topic 450, which is the contingency standard, and it typically means at least 70%. Now, if these two conditions are met, a company would recognize a grant over a systematic basis, really in line with the recognition of expenses that the grant compensates. This means as you incur these expenses, you get to recognize the income. And then finally, the measurement and presentation really depend on the nature of the grant and the company's accounting policies. So in the case of the PPP loans and the ERC, these normally relate to payroll expense. So for presentation purposes, you can offset the related expenses or record other income. Now, just a few key reminders as we wrap up this section. If the arrangement is under specific GAAP, then we encourage companies to refer to that guidance for disclosure requirements. However, if you're not within specific GAAP, which is going to be often the case, then the best practice is to really have transparent disclosures. And depending on the significance of the assistance, the accounting treatment of the assistance should be and probably will be a significant accounting policy. Now, other items companies might consider disclosing include the significant terms and conditions of the arrangement, any contingencies that may exist, and really the form of the grant and the actual duration.
Thank you, Miguel. Lots to think about there regarding government assistance and the accounting models you discussed. Let's go ahead and pull up our first CPE polling question for the audience. Has your company taken advantage of the types of government assistance offered by the CARES Act? Has your company taken advantage of the types of government assistance offered by the CARES Act? I know a lot of our clients have taken advantage, and a lot of other companies that I know of. So I would be interested in seeing what the results are here from the audience. So yes, no, or not applicable. Has your company taken advantage of the types of government assistance offered by the CARE Act? We'll give another 10 seconds. Okay, so interesting. So almost a third, it doesn't apply. We got almost half of that, or a little over half that have taken advantage. About 12% have not, and again, a little over a third that it does not apply to. So, okay. So Miguel, let's go back to you for a minute. You know, as we continue to struggle through these times, a lot of companies, you know, with revenue reductions are having a lot of cash flow deterioration. And so we talked about this before in other webcasts during the pandemic, but you know, just talk a little bit about some of the considerations that management teams at companies need to be undertaken regarding asset impairments.
Sure, Jesus. So we've actually talked about this topic in great detail in previous updates, but I just wanted to provide the group a couple of reminders. You know, companies must continue to monitor and evaluate current conditions for potential impairment indicators. As we've experienced, and many of our clients have experienced a decline or continue to experience a decline in revenue, and some have even been forced to close temporarily. Now, the effects of the pandemic have been very pervasive, but it's really uncertain how long the effects will persist. But an important thing to keep in mind is that factors could be indicators of impairment, but it really depends on the significance and the duration of the disruption. And keep in mind that while short-term disruptions may not indicate an impairment, the effects of a prolonged disruption of activities may cause impairments. Now, if a company determines that the effects of COVID 19 are impairment indicators that require an impairment test. Companies need to make sure they perform those tests in the appropriate order. First, indefinite lived intangibles are tested under topic 350. And one key thing to keep in mind is other assets that include inventory, equity method investments, and potentially other investments that are subject to impairment testing are tested at the same time. Next, long-lived assets are tested under topic 360. And finally, goodwill is tested in accordance with subtopic 350-20. And those are performed at the reporting unit level. But a key takeaway here is that no matter what model is used, we really encourage companies to maintain good documentation, as some specific assumptions and inputs used will require significant judgment and will require very, very robust documentation.
Thank you, Miguel. And just a reminder, particularly, for the public company attendees, that, when you look at your goodwill, you mentioned the reporting unit level. The SEC's, challenge a lot of companies on the identification of the reporting unit, being, it's one level below your operating segment. So if you've got reporting unit identification below that level, you need to make sure you conduct your impairment testing at that level. So I want to turn, along the same lines of cash flow deterioration. Companies are having to reach out to lenders, and they're struggling to make payments, and it's not just banks on some long-term debt, but also vendors for some trade payables and things like that. So Dennis, why don't you talk about some of the troubled debt restructuring matters and other debt modifications, including short-term debt modifications that companies need to be considering?
Sure, Jesus. Want to thank everyone for coming out for our third quarter webinar. For those of you who attended any of the prior ones, you'll notice that this is a recurring topic, and even now in the third quarter, it's still very much in the spotlight as an area that we want to cover. So in previous presentations, we've taken the approach of breaking down the different types of modifications, specifically whether it's a general modification or an extinguishment of debt. Now we want to kind of take it from the TDR angle. Now, I do want to start off by mentioning that under the CARES Act, financial institutions have been given temporary relief from applying TDR accounting only from the lender side. So in order to qualify for this reprieve, the modification would need to be related to COVID-19. The loan shouldn't have been more than 30 days past due as of December 31st, 2019. And finally, the modification should have been made between March 1st, 2020 and the earlier of December 31st, 2020, or 60 days after the end of the national emergency for COVID-19. For those of you who are non-financial institution lenders in the audience, you can also rely on the interagency statement from March 2020 that was put out by banking regulators, which extended the treatment for companies outside of financial institutions. Now, keep in mind that if you're a debtor, you would still need to assess any of your loan restructurings for TDR treatment. Here we have a couple of basically the way that you would identify a TDR and the way that you would account for TDRs as a debtor. So I'll start with the identification of it. First, you would need to be experiencing a financial difficulty. And I'm going to come back to that one, but I do want to say that the second step here, where the creditor has been granted a concession by the borrower, is the more quantitative of the two assessments and should be considered the first step. Now, in order to determine whether a concession is being offered, you would look at the effective borrowing rate of both the restructured debt and the effective borrowing rate of the original debt. If you end up in a position where your new debt has a lower effective borrowing rate than your old debt, then it would be concluded that you are being provided a concession. Once you've passed this quantitative threshold, you should then move on to the more qualitative of the two, where you would have to measure whether you, the borrower, are experiencing a financial difficulty. Now, FASB does provide a non-exhaustive list of items that might point to having a financial difficulty, but by no means is it a complete list. Factors outside of these should be considered when making this assessment. Just an example of some of these, one would be if you, the debtor, are currently in default on the loan, or maybe you are in the process of declaring bankruptcy or already have declared bankruptcy. There's a significant doubt in the company's ability to continue as a going concern. For any public companies in the audience, if your securities are delisted or there's a looming threat of delisting. And finally, if forecasted cash flows are insufficient to service the debt going forward. Now, once you've made the determination that you're dealing would be done by measuring the future undiscounted cash flows related to the restructured debt. And you would compare that to the carrying value of the unmodified debt. So if you end up in a situation where the future undiscounted cash flows exceeds your carrying value currently, then you wouldn't be dealing with any journal entry. Instead, you would just have a new effective interest rate attributed to the loan. On the other hand, if you end up in a position where the future undiscounted cash flows are below the carrying value you currently have, you would record a gain on the restructuring. And that being said, the carrying value would be adjusted to the amount attributed to the future undiscounted cash flows. Additionally, any payments you're making on this loan with new terms would reduce the carrying value of the debt, so you wouldn't be recording interest expense. Finally, any other expenses that are associated with the TDR itself, such as legal fees or other direct costs, these would be expensed as incurred. Before we move on from here, I do just want to kind of touch on how financial institutions should be handling some of these reprieves from COVID-19, basically the suspension of TDR treatment, especially as it relates to the allowance for loan loss calculation for those of you that are still using the incurred loss model, and then for the allowance for credit losses calculation for those of you who have adopted CECL. As it relates to the allowance for loan loss calculation, you should consider beefing up some of the qualitative and environmental factors surrounding your loan portfolios. Specifically, if your loan portfolios are concentrated in geographic areas that have been hit pretty heavily by the pandemic, such as New York or even Florida. And then perhaps if your loans are concentrated in industries that have also been hit pretty heavy by the pandemic, such as airlines or hotels. For those of you who have adopted CECL, the loans that were modified under the conditions set forth in the CARES Act may inherently be a bit different than other loans in your portfolio that haven't been modified. Not saying that they're necessarily impaired, but you may want to evaluate them as a separate category when making adjustments to the ACL. Additionally, you should consider providing robust disclosures on what you're currently accounting for as a TDR and which loans you're utilizing the exceptions provided under the CARES Act. On this next slide here, we wanted to touch on some of the more short-term aspects, specifically vendor payables. And what we've observed is that a lot of these have been restructured into longer-term debt arrangements just because of liquidity constraints. So on this slide here, we have three specific situations that we've seen most commonly in our clients. So as it relates to these three situations, we kind of wanted to go through the cash flow impacts and what you should be disclosing on your statement of cash flows as it relates to each one. So the first situation here is pretty straightforward. You have a vendor payable that's pretty short term, and you want to borrow funds from a financial institution or another lender to immediately pay off the vendor payable. In this case, you would simply record a financing cash inflow for the funds received for the debt. You would record a operating cash outflow for the payoff of the vendor payable. And finally, any future outflows related to the debt would be recorded as financing outflows. In the second situation, it gets a little bit more complex in the sense that instead of obtaining the money from the bank and paying off the vendor, you're negotiating with the vendor and the bank to have the bank pay the vendor directly. Now, in this case, cash never truly enters the company's hands. So a lot of clients have taken the standpoint of not reflecting the amounts in the statement of cash flows, but instead making a disclosure. Now, we would think that this is a little bit more similar to the first point. Even though cash isn't entering the company's hands, the bank is still acting as an agent on behalf of the company. So you should still be recording this similarly to the first, with a financing cash inflow for the debt, an operating cash outflow for the vendor payable, payoff, and finally, financing cash outflows for any future payments on the debt. The final bullet point here that we have just talks about when you make arrangements directly with the vendor. So no financial institution involved or any other lender. You're just extending payment terms or perhaps refashioning it into a long-term payable. In these cases, you would still record the subsequent payments on the newly modified vendor arrangement as operating cash outflows because it still relates to a vendor and it's part of your core business operation. Also, the arrangement itself would not constitute a cash inflow because the arrangement already exists. So nothing would need to be shown for the modification on that front.
Thank you, Dennis. What about, when we talk about a lot of these accounting issues, particularly for our publicly traded companies that need to comply with SOX, what about some of the internal control considerations and really along those lines, not just with respect to these modifications or trouble debt restructuring, but also more broadly during this time, what are some of the internal control considerations that companies need to be looking at in the context of their financial reporting?
Sure, Jesus. And I would say before we even get into some of these specific considerations that we have here, I do just want to state from an overall standpoint, high level, that the virus's impact on the economy, as well as our working conditions, which have now, for many of us, turned into a completely remote situation, have had pretty impactful changes on company internal control structures with varying levels of severity depending on the industry. So I would ask everyone to the extent that it hasn't been done already, to take a step back and go through your current internal control, risk control matrices and your control listings and ask yourselves, has COVID forced you guys to make changes, or has it prompted unusual and infrequent transactions such as debt financing arrangements that normally wouldn't be contemplated outside of this and may require refined or new controls? Or have there been any processes or controls that have temporarily or permanently stopped due to COVID? Also, have there been changes to the ways that controls are performed, or perhaps technology used in performing certain controls? These are all things that should be heavily considered because it's going to be very necessary to make sure that these things are functioning properly to ensure accurate financial reporting. Now, getting into some of the specifics, we do have a list here, just a short little bullet point list of some specific control types that we've seen impacted as a result of the pandemic. So first one we have here would be related to management review controls. Specifically, these would cover infrequent transactions, sensitive areas to the financial statements, reviews of subsidiary financial results, and budget to actual assessments. So in the case of management review controls, we're really concerned more so with the quality of data that's contributing to management's analyses, as well as just some of the underlying people and process changes that might be feeding in information that they're reviewing. So in response to this, we would recommend refining financial statement close checklists, maybe including additional information for review that might assist in these times of uncertainty, identifying backup individuals that might be able to provide these reports, and of course just having more check-ins along the way, maybe setting up calls throughout the month, throughout the quarter, just to make sure that everything is prepared adequately. Segregation of duties, especially with furloughs and layoffs, have left companies in situations where they have individuals that are performing conflicting duties. Now, to the extent that it's possible, we would recommend repurposing people within the organization to put them into positions that might be able to prevent some of these conflicting duties for individuals that can currently perform them. Additionally, try to identify if there are any other compensating controls that are in place to cover any segregation of duty issues. Finally, we have here some controls over areas sensitive to estimates, which would kind of be an extension of management review controls. But we just wanted to highlight some of those areas such as AR allowances or loan allowances and inventory reserves, goodwill and deferred tax asset impairments and valuations, and then of course just projections that might assist in the overall assessment for these items. These should be very carefully reviewed. Before we move on, just want to make a quick note here about any service organizations that are being used by your company. Just as you have been impacted by the COVID-19 pandemic, so have some of these service organizations. Their control structures may have been severely impacted to the point that their SOC 1 Type 2 reports may come up with deficiencies that you may not have expected from previous years, or even worse, might end up with a qualified opinion. So really, depending on how crucial a service organization's controls are to your control environment, we would recommend just keeping in close contact with them just to keep abreast to any changes in their control environment. And of course, just have backup plans ready, such as compensating controls or maybe even new controls entirely that might strengthen some of the reviews over those service organization processes. On this table here, we just have a couple of internal controls over financial reporting impacts that we've seen, just some of the recommended responses. I'll briefly go through these. In the first one, we have changes to individuals performing the control activity. So this would typically happen in cases where there's furloughs and layoffs that would generally require a new control owner to take over some processes. So really, it's just a matter of making sure that they're transitioned properly and understand what they're doing and have adequate training. And perhaps during that time of transition, just making sure there's a more extensive review on the controls that they're performing. There may also be changes in the way that a control is executed in evidence. For example, a control may have been previously evidenced by in-person meetings and board minutes or minutes to that meeting to accompany it. But maybe now, due to the remote environment, it's mainly kept in email trails or things of that nature. So really take a step back and question whether it's sufficient evidence, or maybe there's other evidence that's needed in order to properly evidence the performance of the control. Of course, we'll mention again just areas highly susceptible to misstatement, whether it's a fraud risk or just sensitive estimates. These should have even more review during these times of uncertainty, with enhanced professional skepticism from a management review approach, just to make sure that the assumptions being used are appropriate, make sense, and will lead to reasonable and accurate financial reporting. And then, of course, just maybe for this time period in general, just temporarily requiring dual authorization, just to have another person's eyes on these analyses. Finally, we have here just talking about changes in the frequency that a control is performed, if those have changed. So this could happen both ways, maybe due to the sensitive nature of certain things. Maybe a control has been changed from monthly to weekly, or maybe if there's a constraint of resources, it's been changed from monthly to quarterly. So before making these changes, especially in the sense when a control becomes less frequent, ask yourself, can the decreased frequency still prevent or detect and correct a material misstatement? And do any of the reports that are being used to evidence that control, or any other evidence being used, need to be modified in order to accommodate the new frequency? And of course, just making sure that every interested party is communicated of the frequency change, such as governance and external auditors, et cetera. Just want to say, for public companies in the audience, I would not expect the SEC to provide any reprieve for internal controls over financial reporting related to COVID-19, especially because their previous statements leading up to this point have definitely made a strong emphasis on very comprehensive and high quality financial reporting. So it's very likely that they will expect that internal controls over financial reporting are able to support that. So just want to close here by saying that I know these times have been difficult for people, but it's important to reflect upon the changes that have been promulgated by the pandemic. Take the time to evaluate which controls have been difficult to perform remotely, perhaps take an inventory of controls that should be improved or maybe replaced, just to augment your organization's crisis readiness going forward.
Thanks so much, Dennis. A lot to think about regarding internal control over financial reporting. Always tied in directly to a lot of these technical issues and these ad hoc things that come up. So, we all have that perspective that we don't expect any reprieve on SOX from the SEC. So sort of along the lines of these continuing issues, this is a broader theme, but going concern is a topic that in the last few years, management had to take a much more direct responsibility for assessing the company's ability to continue as a going concern. So given what's going on now in the environment, the granularity with which management must be conducting these analyses to prove this out is increased a lot, and the scrutiny with which the auditor looks at these things is increased as well. So we're not Patrice talk through some of the going concern considerations that management teams need to undertake during this time.
Certainly, Jesus, thank you. So as you mentioned, we have seen in the last 6 months and what COVID has done to our global economy. And there has definitely been a lot of negative trends in terms of financial performance, liquidity, and even changes in cash flow projections for many companies. So although a detailed analysis may not have been necessary in the past, in light of current circumstances, this analysis is more of a fact of life, at least until the economic conditions improve. During these times, also the investors and stakeholders are now more interested in disclosures around going concern. So here we want to discuss a few key reminders under the guidance of ASC subtopic 205-40, which became effective back in 2017. Under the standard, it's management responsibility to assess the entity's ability to continue as a going concern each annual and interim reporting period. This is a two-step process, which requires determining whether it's probable that the entity will be unable to meet its obligations over a period of 1 year from the assessment date. So we want to highlight here that the assessment date is the day the financial statements are issued or available to be issued. This is such a key factor in the analysis. We want to highlight that the assessment period is not 1 year from the reporting date or the balance sheet date, which some may think, but again, that from the date of when the financial statements are issued or available to be issued, which is ideally the opinion date. So when you consider this means for some entities, you could be looking at periods 15 to 18 months or even more after the balance sheet date. Also keep in mind, this is a rolling analysis that should be completed at each reporting period. So therefore, it should be completed at an interim date for those entities with quarterly reporting requirements. Listed here, we have the 2 steps under the going concern guidance. Under the first step, assessing if substantial doubt is raised, here management evaluates whether events and conditions, both quantitative and qualitative, considered in the aggregate, because we want to make sure we look at all events there together, raise substantial doubt about the entity's ability to continue as a going concern. In step 1, management needs to perform a thorough analysis, looking at all the entity's debt arrangements and looking at the detailed cash flow forecast for that assessment period. All known and reasonably knowable events should be considered to determine the impact on the cash flows and liquidity. If management determines events and circumstances do not raise substantial doubt, then you conclude with no disclosure and no further action is necessary. Otherwise, we have to proceed to step 2, which is assessing if substantial doubt exists. Under step 2, management determines whether it has plans to alleviate the substantial doubt raised in step 1. It is common for entities to obtain a support letter in this analysis to demonstrate the financial support by third parties or the entity's owner manager to alleviate substantial doubt. We have to keep in mind here, however, a support letter by itself is not sufficient to prove the supporting entity's ability to provide the needed financial support. The solvency of the supporting party must be also assessed. This can be done by reviewing the audited financial statements of the supporting party, if that's available. And if not, we can look at other documents such as bank statements, evidence regarding the valuation of the assets used to ensure that they're sufficient to provide the needed support. We also have to keep in mind that we must assess any claims against such assets, since claims against the assets would limit the ability of the supporting party to use such assets to provide the support. Even when management plans to alleviate substantial doubt, certain disclosures are still required in the financial statements. As we have listed here, the financial statements must disclose the conditions that give rise to substantial doubt before the consideration of management's plans, management's evaluation of the significance of those conditions or events, and thirdly, management's plan to alleviate the substantial doubt. When management's plan do not alleviate the substantial doubt, the financial statements must disclose that substantial doubt exists. This is the key difference in the disclosure between when substantial doubt is alleviated versus when it's not. In addition, the audit report is modified to include an emphasis of the matter paragraph, which highlights that substantial doubt exists. There are some other disclosures to consider. Risk and uncertainties under ASC 275 should also be considered. And also for SEC clients, there are MD&A disclosures on liquidity and capital resources, also disclosures on risk factors as well.
Thanks so much, Patrice. So let's go ahead and bring up our second polling question related to going concern. And that's, has your company performed or expects to perform a COVID-19 related going concern assessment? Yes, no, or it does not apply to you. Has your company performed or expects to perform a COVID-19 related going concern assessment? So a lot of companies, a lot of our clients are undertaking going concern assessments that they historically have not, and which seem to be pretty directly tied into COVID. So again, has your company performed or expects to perform a COVID-19 related going concern assessment? We'll give the audience another 10 seconds. Or 5 seconds. So we've got about under a third are, little under a quarter of you are not, and pretty much half of them are not applicable. So interesting results. So, okay, so we are now going to go through some SEC trends and updates. And I just want to touch briefly on SPACs. You know, special purpose acquisition companies has been a theme, particularly during this year and during the time of the pandemic, that we've all heard about, read about. It's you know, reading all the business journals and all the publications and watching all the shows, you're hearing about SPACs all the time. So, you know, a SPAC offers an IPO alternative effectively to private companies that want to enter the public markets. It's a blank check company. That's what these types of companies are. They raise capital from investors in an IPO with the plan to use that capital to deploy it in the future to acquire a target that has not been identified at the time of the IPO. So what we see generally are targets that are usually more like mature private equity portfolio type of companies, particularly as of late. So SPACs have actually been around since the 80s. There was a bad connotation back in the day, and you know, there's increased popularity now, and it's being used pretty heavily actually this year, which is a record year. SPACs have raised over 31 billion, and you know, we're still in Q3. This includes the biggest SPAC ever, deal that Bill Ackman, the hedge fund manager, put together. It was a $4 billion SPAC, went public in July. And so what's different about a SPAC? The SPAC's initially capitalized by sponsors that contribute pretty nominal capital for founder shares that make up 20% of the post-IPO shares. I'm not going to go through all the things. There's a lot of technicalities here. I'm trying to get just at a high level. You know, when you go in through the SEC with a SPAC, it will generally declare the SPAC effective much more quickly than a traditional IPO registration statement. Staff will usually issue fewer comments on SPAC S1s as well, so those comments are quicker to clear. After the IPO, a SPAC will generally file an audited balance sheet that shows at least 5 million of net tangible assets to avoid trading restrictions. There's certain rules that would restrict trading, some blank check rules that would restrict trading if it's below 5 million. So that's a pretty small number, and we're seeing SPACs obviously in the billions now. So a SPAC would generally have about 18 to 24 months from the date of the IPO to acquire a target. If not, they would return that money to the investors. So some of the special accounting and financial reporting requirements of a SPAC: determining the predecessor entity. So which entity winds up being the predecessor whose financials will be the historical financial statements of the combined company. Typically, the target company is the predecessor, or there could be a case where there are multiple targets. You have a SPAC that actually has different entities being acquired. So in that case, what you would do is you would have the acquired business that you know, constitutes the majority of the ultimate business or operations of that combined company, the newco, and that would be your predecessor, your historical registrant for SEC purposes. So in making the predecessor determination, there's really no one determinative factor. It's really a facts and circumstances based approach, which is typical in our profession and we love. Targets that do wind up being considered the predecessor must be audited in accordance with PCAOB standards. Many times when that happens, it winds up being an issue for the legacy auditor of the target, because many times these legacy financials were audited under AICPA standards, which allow for assistance in the preparation of the financial statements. So auditors will find themselves in a bind and have an independence issue from a PCAOB perspective that was not necessarily an independence issue of the AICPA under their auditing standards. So you wind up having to change auditors in many instances. Determining the accounting acquirer. So for accounting purposes, you look at ASC 805 on business combinations, and that's generally the the guidance that would determine what governs the determination of the acquirer. So which entity is it that has obtained control in the transaction? Many times the acquirer is the legal acquiree, which makes the legal acquirer the accounting acquiree. And generally in a deal where the SPAC acquires a business in an all-cash deal, the SPAC is the acquirer. But in cases where there's equity consideration or there's a mix of cash and equity, you need to determine control, whether it's been obtained through a variable interest, like a VIE model, or a voting interest model. If the acquiree is a VIE, then your typical VIE guidance would apply. You look at who's the primary beneficiary. Now, the acquiree in a SPAC merger typically is a voting interest model, and determining the controlling financial interest requires a lot of judgment. This is actually one area, this is probably the most highly commented area on in a SPAC S1. So you would have to evaluate relative voting rights in the new company, the existence and size of the single minority voting interest in the new company, the composition of the governing body of the board and of the management team, the relative sizes of the entities to the combined entities, to the combined entity, and the terms of the exchange of equity interests. So really complicated analysis, and typically if you've been involved in these, there's generally a very lengthy memo that winds up having to be submitted to the SEC to support its accounting acquirer determination, because again, it is the most high one. I think it's probably the most highly commented item in a SPAC deal. So EGC eligibility, emerging growth company, which under the Jobs Act back in the day gives a lot of reprieve to companies that go public and meet certain criteria. So the assessment of whether this new company continues to qualify as an emerging growth company after a SPAC merger depends on whether the SPAC acquired the target in a forward or reverse acquisition, so a typical business combination or reverse merger. For a forward transaction, typically you look at the historical revenues and market value of the SPAC, but in the case of a reverse acquisition, the target entity metrics are the ones used in place of the SPAC. ICFR, internal control over financial reporting. So from a SOX perspective, those considerations are dependent on whether the SPAC had a 10K on file. Maybe you have to have a SOX assessment under 404A, which is just management assessment. So an entity may not necessarily have to comply with SOX if there's no K on file at all that year. But you may have to do 404A, which is just management's assessment. If you do have a K on file, and for the first 5 years, you do just typically if you're an EGC, you do just 5 years of the management assessment, and you don't have to have an auditor assessment, which is under 404B. There's a lot of different things that are considered here. You have to understand, if you're you may not necessarily be an EGC, you may not, or you may be an EGC and trigger one of those 5, I think it's 5 criteria that they have for you to, continue to maintain that status. You got to look at your filer status. If you're, wind up being a large accelerated filer, if you're a smaller reporting company. So there's a lot of complexities in just the determination of the applicability of ICFR. Super AK requirement. So within 4 business days of completing the SPAC merger, the new company must file an AK. It's a pretty encompassing AK. They call it a super AK. It's effectively like a 10K. It includes financial statements among many other typical annual requirements that are in an Exchange Act filing like that. And one thing worth noting here is whereas in a typical AK that includes a normal business combination under 901, you actually do not have this 71-day extension in a SPAC deal. You have to actually have all the information within the 4 days. So you don't have a total of 75. You have to do it in 4. Post-transaction considerations. After the SPAC transaction, the new company is public and has typical responsibilities of a public company, with typical recurring Exchange Act filings, 10Ks, Qs, 8Ks. The new company could file an S3 and related prospectus supplements that consummate follow-on equity offerings. They generally would qualify for S3 usage within 12 months, which is typical, 12 months of the IPO. They are, however, disallowed from qualifying as a well-known seasoned issuer for 3 years following this shell company status change from the SPAC merger. So what this means is a well-known seasoned issuer generally will do an S3 and will get, automatic, will become an automatic shelf registration. They get immediately declared effective. In the case of a SPAC, it would be subject to review by the SEC, and then the SEC would have to go through the typical process to declare it effective. So I want to go ahead and go with Emma here to talk through some of the SEC non-GAAP measures related to COVID-19.
Great, thanks, Jesus, and good afternoon, everyone. So earlier this year, in March and June, the SEC's Division of Corporation Finance issued a couple of new disclosure guidance topics, topics 9 and 9A, which provide new guidance on disclosures and other considerations associated with the evolving impact of COVID-19. And these new disclosure guidance topics include new guidance on earnings releases, non-GAAP measures, and also other material non-public information. So topic 9 in particular notes that if a registrant elects to reflect various impacts of COVID-19 in their non-GAAP measures, it would be appropriate to highlight why management finds the measure or metric useful and how it helps investors assess the impact of COVID-19 on the company's financial position and results of operations. So when using non-GAAP financial measures, a registrant must be aware of certain SEC requirements, including rules in SEC Regulation G and Regulation SK, and there are also a number of other compliance and disclosure interpretations available. So non-GAAP measures have historically been an area that's closely scrutinized by the SEC with a consistent stream of comment letters issued, and we can only expect that the SEC will continue to closely scrutinize such disclosures, especially as companies may now be adding new adjustments to these non-GAAP measures, including adjustments related to COVID-19. So to provide some background, the SEC outlined certain key requirements for disclosure of non-GAAP measures, or non-GAAP information really in SEC filings, which includes also press releases. So first of all, the most directly comparable GAAP measure needs to be presented with equal or greater prominence as the non-GAAP measure. Next, registrants need to present a qualitative reconciliation of both of the non-GAAP measure to the most directly comparable GAAP measure, and they should also very transparently describe all the different adjustments within that reconciliation. Also, registrants need to clearly label and describe non-GAAP measures and adjustments, but should not, for example, use titles or descriptions that are either vague or maybe confusingly similar to those used for GAAP financial measures. So for example, instead of describing an adjustment as, let's say, effects of COVID-19, a registrant should specify what the adjustment includes. And finally, within these key basic requirements, registrants are required to disclose why they believe that the non-GAAP measure provides useful information to investors, and also to the extent that it's material, a statement disclosing how management specifically uses the non-GAAP measure. So in addition to these key requirements that we just outlined, an overarching theme of the SEC guidance on this topic is that non-GAAP measures should not be misleading, regardless of whether the measures are used in a filing, such as in a Form 10Q or a Form 10K or elsewhere, such as in a press release. So some examples from the guidance of non-GAAP measures that could potentially mislead investors may include those that, for example, exclude normal recurring cash operating expenses that are necessary for business operations, or those that are presented inconsistently between periods, those that exclude certain non-recurring charges, but then conversely do not exclude non-recurring gains. So that would be a form of cherry picking between non-GAAP adjustments to achieve a most positive measure, and that wouldn't be allowed typically. And then also those that are based on individually tailored accounting principles, including certain adjusted revenue measures. So further, when evaluating whether a COVID-19 related adjustment is appropriate in a non-GAAP measure, registrants should consider several factors, including, among others, whether the adjustment is truly directly related to COVID-19 or the economic downturn associated to it, or incremental to normal operations and truly non-recurring, meaning it's an adjustment that's not expected to become the new normal. Additionally, any such adjustments need to be objectively quantifiable, right, as opposed to maybe an estimate or a projection. So on the next slide, we have some examples of potential COVID-19 related adjustments that registrants might consider in their non-GAAP measures. Now, keep in mind these are some broad general examples, and each registrant must consider their own facts and circumstances in light of the SEC rules and guidance. So we encourage you to take into account the purpose and the use of the resulting non-GAAP measure and the context in which it's presented. So to give you a few examples of adjustments that are likely to be consistent with the key SEC requirements and interpretations that we just outlined, those would include, for example, adjustments related to impairment of goodwill or indefinite lived intangible assets or impairment of other long-lived assets. Or, for example, in a current environment, you might have adjustments related to contract termination costs, which is lease breakage costs. Or another such example on here that we have would be, employee termination or other restructuring costs. Now, conversely, if we were to give a few examples of adjustments that are unlikely to be consistent with SEC requirements and interpretations, those we believe would typically be related to, for example, estimated lost revenue or profit, because those amounts cannot typically be objectively quantified, meaning the estimate is not an actual cost or benefit. And another example of something that would be unlikely to be consistent with the SEC requirements would be non-temporary increases or decreases to salary, for example, because if these increases or decreases are non-temporary, then you would expect them to become part of the new normal of the registrant's cost structure. So to reiterate some of the concepts described thus far, any new adjustments or changes to non-GAAP measures related to COVID-19 should be clearly labeled, and changes to such measures should be transparently disclosed. And also, a registrant should be consistent in its presentation of non-GAAP measures between periods. So when a non-GAAP measure is initially used or subsequently modified, a registrant should consider whether the adjustment or adjustments, there are multiple, would materially affect prior periods. And if a new adjustment for an item in the current reporting period also occurred in the prior period, then the registrant should consider retrospectively adjusting the prior period non-GAAP measure for consistency purposes. And finally, if new adjustments to non-GAAP measures are in fact added as a result of COVID-19, an entity should ensure that its disclosure controls and procedures address the assessment and the approval of the revised non-GAAP measures, including the consistency of presentation between periods, like we just mentioned, and also transparent disclosures about any changes. So with that, I believe we're now ready for our next polling question.
Yes, Emma, thank you. So our third and final polling question for you to obtain your CPE, and we're between this and our last slides here. Has your company provided or expect to provide additional disclosures related to COVID-19 in your financial statement? Yes, no, or not applicable. We'll give the audience 15 seconds or so. Have you provided or you expect to provide additional disclosures related to COVID-19? Okay, so we've got 43% that are, 13% are not, and 44% it does not apply. Interesting. We have a lot of people where it doesn't really apply. That's in theory, that's good. Okay, so we have a couple of slides here from FASB update. We're just at about our 1 hour mark. So, listed here are some of the updates that were issued within the quarter by the FASB. We won't go through them, but just there for your education. 2020-06 is a simplification of accounting for convertible instruments. Pretty complicated accounting. The guidance addresses 3 main provisions. The new guidance reduces the number of accounting models for convertible instruments by eliminating the beneficial conversion feature and the cash conversion models. FASB expects these changes to make the accounting less complex and the financial reporting results to be more relevant for users to understand. So there's also a simplification in the EPS calculation for certain convertible instruments. Among other provisions, the standard requires that the effect of the potential share settlement be included in the diluted EPS calculation when an instrument may be settled in cash or shares. Some other proposals that the FASB put out there: a delay in the standard for the insurance companies that issue long-term duration contracts, one on the conceptual framework, and one on determining the fair value of share option awards. Also one on some lease proposals, sales type leases with substantial variable lease payments, remeasurement of lease payments based on an index or rate, and a reduction of scope in a master lease agreement. So we're just at the 1 hour mark right now. So we want to thank everybody for their time. Again, as I said at the beginning, you should get in the next day or two an email that will include the presentation, a link to the archive of the presentation, and you'll have your CPE certificate as well. So there's, as you all saw, there are many matters to consider around asset realizability, short and long-term debt modifications, internal controls, and a lot of rules FASB and SEC have out there. So you need to evaluate that very thoughtfully. So this wraps up our 2020 Q3 update. I hope everybody enjoyed it, and stay safe, and see you next quarter.